Hey everyone, welcome back to Corporate Decoder, the place where we break down the dense language of big business to find out if a company is really pulling a fast one or if they are genuinely moving the needle. Today we're looking at a report from Service Corporation International, and it seems they've been busy behind the scenes securing some serious financial backing. So what is the big news here? Well, it looks like Service Corporation International, or SI as they're known on Wall Street, has just inked a new deal that gives them access to a hefty sum of money to keep their operations humming and potentially grow. This isn't just a small loan, this is a major financial move that can signal a lot about a company's plans and its confidence in the future. And for us regular folks, that means understanding where our money might be going if we own a piece of this company. Alright, so what we are seeing here is that on the 20th of November 2025, Service Corporation International entered into a significant new credit agreement. Think of this as a major financial handshake with some big banks. This deal essentially gives them access to two main things. Firstly, a $750 million senior term loan facility. Now, what does that mean? A term loan is basically a lump sum of money that a company borrows and pays back over a set period. This specific loan is set to mature in November 2030, which gives them a good 5 years to pay it back. The term senior and senior loan means that in case of any financial trouble, these lenders get paid back before other lenders who hold what are called subordinated debt. It is a safer bet for the bank and maybe a little more costly for the company. Secondly, and this is a big one, they have also secured a revolving credit facility. This one is huge, providing up to $1.75 billion. Now, a revolving credit facility is like a very large credit card for a business. They can borrow money, use it, pay it back, then borrow it again as they need it up until that $1.75 billion limit. The commitments for this also expire and the loans mature in November 2030, just like the term loan. So basically they have access to a massive flexible pool of money for general business needs, growth, or whatever opportunities come their way for the next 5 years. The combined agreement for both is referred to as the credit agreement, and it is designed to support the company's ongoing operations and future initiatives. Now here is a crucial detail. All the money borrowed under this new agreement is guaranteed by Service Corporation International's current and future domestic subsidiaries. This means if the main company can't pay back the debt, the banks can go after the assets of its subsidiary companies in the US. This is a standard practice to strengthen the collateral for the lenders. It shows the company is confident in its overall structure and the performance of its subsidiaries. Let's talk about the cost of borrowing this money. The interest rates on these loans can change based on different benchmarks. The company gets to choose one of three ways to calculate the interest. One option is an alternate base rate plus an applicable rate. This alternate base rate itself is a bit complicated, involving a few benchmarks like the NIFRB rate, the prime rate, and a 1-month term SOFR rate. The other options are term SOFR for a chosen period or an RFR rate. In simpler terms, they have options for the interest calculation that can depend on market conditions. The actual interest rate they will pay, the applicable rate ranges from 0.25% up to 2%. This rate depends on how much debt the company already has compared to its assets or earnings, which is called the leverage ratio. If their leverage ratio is low, meaning they don't owe a lot of money, the interest rate will be lower. If it is high, the rate goes up. This is a common way for banks to manage risk. They want to be compensated more if the company is carrying a lot of debt. Besides the interest payments, there are also other fees involved. These are called customary fees and include things like letter of credit fees, which you pay if you are using the credit facility to guarantee a payment to a third party, and commitment fees. Commitment fees are usually paid on the part of the credit line that the company isn't using. It is essentially a fee for having that money available to them. So even if they are not actively borrowing every single dollar, they are still paying a small price for the access. Now for the restrictions, this is where we see what the company cannot do. The credit agreement comes with what are called negative covenants. These are rules that limit or restrict what the company and its subsidiaries can do without the lender's permission. These are really important because they can affect how the company operates on a day-to-day basis and its long-term strategy. Some of the major restrictions include limits on taking on more debt. That means if they want to borrow more money from somewhere else, they might need permission from these new lenders. They also cannot easily grant liens, which means they cannot pledge their assets as collateral for other loans without agreement. Making new investments, changing their business structure, or paying out too much in dividends to shareholders are also likely restricted. Essentially, the lenders want to make sure the company remains a safe bet, and they put these rules in place to protect their investment. A big one here is the leverage ratio itself. The company must maintain a leverage ratio of no more than 5.00 to 1.00. This means for every dollar of earnings or assets, they can't have more than $5 in debt. And there is a small exception. If they make a big acquisition, a qualified material acquisition, they get a temporary boost to 5.50 to 1.00 for a few quarters. This shows the lenders are keeping a close eye on the company's debt levels to ensure financial stability. They want to see responsible borrowing. On the flip side, there are also affirmative covenants. These are things the company must do. The most important of these are ongoing financial and other reporting requirements. This means Service Corporation International has to regularly share detailed financial information with the lenders. This keeps the lenders informed about the company's health and performance, ensuring transparency. So really, this first section is all about a large debt agreement. Item 2.03, which is basically just confirming this debt is now officially on the books. It is a direct financial obligation. So to recap this whole section, it's all confirming that the big borrowing agreement we just talked about is official and now part of the company's financial picture. Then we get to the appendices or exhibits. This is where they attach the important documents. The most important exhibit here is the actual credit agreement itself. Think of it as the full unedited contract between Service Corporation International and the banks. This document contains all the nitty-gritty details that we've summarized. It is dated the 20th of November 2025 and lists JPM Morgan Chase Bank NA as the main agent for all the lenders. And finally, the report is signed by Eric D. Tansberger, the Executive Vice President and Chief Financial Officer. This signature essentially says that he has reviewed this report and confirms its accuracy to the best of his knowledge. Alright, let's zoom out and talk about what this all means for Service Corporation International SI. On the surface, this is a very positive move. Securing nearly $2.5 billion in credit shows a lot of confidence from major financial institutions in the company. It means SI has a strong relationship with its banks and they believe in its ability to generate enough cash flow to service this debt. This massive credit line gives them serious flexibility. They can expand their operations, make strategic acquisitions, or weather economic downturns with more confidence. Given that Service Corporation International is a leader in the deathcare industry, a fairly stable and recession-resistant sector, this credit facility likely aims to support their long-term growth and consolidation strategies within that niche. However, there are always risks to consider. Taking on a large amount of debt, even with favorable terms, adds financial leverage. The covenants we discussed mean that the company's strategic freedom is somewhat constrained. They cannot just do whatever they want, they need to operate within the boundaries set by the lenders. If the company's performance falters and they struggle to meet the leverage ratio requirements or other covenants, they could face penalties or even default. The interest rate fluctuations are also a factor. While they have some control over the base rate, the market can always push rates higher, impacting their borrowing costs. Looking at it from a Warren Buffett perspective, we want to see a company doing business in an industry it understands with a strong management team and fair valuation. SI is in a stable industry and this credit facility suggests they have a capable finance team managing their capital structure. The cost of this debt and the restrictions it imposes are the key considerations. The company is essentially betting on its future earnings to comfortably cover these new obligations. If they can continue to grow and maintain profitability, this will likely be a very successful move, enabling them to strengthen their market position. But if the economy shifts or their operational execution falters, the covenants and debt repayments could become a significant burden. In conclusion, Service Corporation International has significantly enhanced its financial firepower. This move positions them well for future growth and operational resilience. The key will be their ability to manage this new debt responsibly and navigate the restrictions while continuing to execute their business strategy effectively. Alright, that is our breakdown of Service Corporation International's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.